Hello and welcome to Livewire's Buy, Hold, Sell. I'm Matthew Kidman and today we're going to cut and dice the good, the bad, the ugly from the reporting season, which is coming to a screeching halt. And thank goodness, because it's been exhausting. And to walk us through this, we've got David Wilson from First Sentier. Welcome, David. And we've got Michael Wayne from Medallion Financial. And let's start with you, David. Let's you make your focus right in on the action. One word to sum up the reporting season.
Varied. You had results literally all over the place. You had some good results where you had quite extreme positive reactions, and then you had others where you had quite negative reactions. So varied is how we'd sum it up.
That volatility, how do you handle it?
In most cases, you've incorporated into your process and you're trying to be aware of it. You don't try and really trade on the back of it too much. But if there's an opportunity where you think there's an extreme move, then you take advantage.
I like that. Don't trade straight away. Digest it. Okay, Michael, give us one word.
Downgrades. So despite the fact that there have been more earnings beats than misses, the brokers have come in pretty hard and they've cut a lot of the outlooks for these businesses. So the market was expected to grow at 5% pre-earnings season for FY25. It's now expected to grow at 3%, so downgrades.
No doubt the 25 outlooks have had a big impact on the announcements, more than any other time I can remember.
Yeah, definitely. Management have been very cautious. Probably understandable given the environment that we're transitioning through and the uncertainty around inflation and interest rate cuts, even if they cuts do eventuate. So yeah, management have been very, very timid on the outlook.
Okay, we're going to talk about headwinds and tailwinds. Given you're on a negative tone, give us some of the headwinds that are out there at the moment in terms of companies reporting and their results.
Well, the headwinds continue to be costs, whether that's labour costs, whether that's cost of inputs. So that continues to be a strong headwind facing a lot of companies. But there have been some tailwinds as well. We've seen the growth businesses do particularly well, despite the choppy environment, despite lofty valuations. As a cohort, they seem to have delivered results that have beat more than missed relative to many of their peers.
It's hard to beat growth, David, but what are some of the tailwinds?
I think what we saw in terms of tailwinds is that you saw quality companies generally outperform their lower quality peers. So you look in the mining sector, BHP and Rio did a lot better than the other mining companies and even the oil and gas companies as well. And similarly, you look at the earnings from the likes of REA Group and car sales, they certainly outperformed the likes of Seek and Domain.
So you're backing good management? Good
management and good quality businesses.
Yeah, and what about those headwinds?
And the headwinds,
what's giving you a headache?
I think the headwinds there, we saw it particularly in the mining sector. As Michael said, you saw it in the resources space where costs and CapEx did sort of blow out appreciably. It was a noticeable headwind across the mining stocks and the oil and gas companies as well.
Yep, so here's the money question. This is what you get paid for. I know you said you don't trade straight away, but you've seen a lot of the results now. Portfolio changing at all and where you're tilting it to?
We didn't do a lot through reporting season, unfortunately for our broking friends, but we did take a little bit off the top of the banks and just sort of sprinkled it across the rest of the portfolio. You know, the banks are performing well, sound ROE, sound businesses, but valuations did get a little extended, so we took a little bit off the top there.
So does that mean you think market leadership's changing? Because the banks have led the charge in the last quarter or so.
Yeah, we don't really sort of take a sort of strong view on market leadership. You know, we're sort of building portfolios, but I think the bank stocks are generally sort of fine in terms of the results they've delivered, but I think valuations, you have to recognise, did get a little extended.
How about you, Michael? As I said, it's the money question. What are you doing with that portfolio? What are you tweaking?
So not so much based off the tailwinds or headwinds for the markets, but generally speaking, if a company reports well within the portfolio, we do tend to back that and actually put some more money to work in that name. Likewise, if a company reports poorly and it looks like the outlook has changed in a sustained way, we'll look to exit that business, but let the winners run, even add to some of those winners and try and maybe cut some of those losers quickly.
And from your earlier answer, does that mean a bit more with growth, structural growth stories that seem to motor ahead regardless of the headwinds?
Yeah, as it's turned out, that's definitely been the case. We do think that the outlook for many of those businesses, if anything, has enhanced somewhat. Obviously, you can't just pay any price for growth, but growth at a reasonable price, as lame as it does sound, still, I think, has a valid place in many portfolios.
And something else we always look at is what the company's going to give us as shareholders. Yeah. Income, buybacks, anything take your eye and stood out in that front?
Yeah, growing dividends for us are always the key thing that we look for. It's not so much the dividend yield today, but if that dividend per share in 2 or 3 years' time can be substantially higher than where it is today, that's always a positive sign for us. There's one business, a small cap quality name that we've discussed before on Livewire, XRF Scientific. That's a company that once again delivered a very good dividend per share growth number, and that dividend's now doubled in the space of 3 years. So if you can identify similar businesses across the portfolio, that's something that we're looking for.
I like that one. I think we own it. So I'm going to stick
Very
with it.
good.
What about you, David? Dividends are important to the general public, but I get the feeling you are not so enamored in elevated dividends to prop up companies.
We're a little bit sceptical. We often term dividends and capital management as the last refuge of the desperate, where if the company's in trouble or under a bit of pressure, earnings under pressure, often they will go and pay shareholders to wait, either delivering them some extra dividend or a capital return. So we can be sort of sceptical of it, but we do like to see efficient capital management. So if you've got franking, the company should pay it out. And, we would rather them, maintain their sort of capital process and maintain the discipline without going and sort of, wasting it on our acquisitions.
So beware the special dividend, you think?
Just question it. Be sceptical.
Very good. Okay, this is the stuff we really like. Finding those companies that had a good result, but the market probably hasn't tweaked to it yet. Is there one you've got up your sleeve that you can talk about?
Yeah, it's a pretty straightforward one. It's Goodman Group. The market was a little bit disappointed on the day because it gave guidance that was below consensus forecasts. But the fact is that Goodman have a real track record of actually delivering upgrades on their initial guidance throughout the year. And I think the market got a little bit caught on the fact that it didn't quite meet that.
Market's still falling for it. They do it every year.
Yes, that's right. And some years more so than others. And I think this time around they perhaps did a little bit more so than we thought was warranted.
And why do you like Goodman Group?
Goodman Group's, they've got a fantastic sort of property portfolio. It's internationally diversified. It's in sort of the key sort of cities around the world. And you've also got the upside from data centres as well.
Okay. What was your sleeper, Michael? Something at the bit smaller end?
Dusted off Credit Corp, which seems to come
Had a
and
hard
go.
few years, hasn't it?
Yeah, it's had a hard decade and a half. It has its moments where it's a shining light and then it's sort of down in the despair. And it's been in that phase recently with higher interest rates and higher inflation, making it very difficult for people to pay back their debts in arrears. But there are some signs, looking at Credit Corp's result and some of the competitors also in the US, that conditions are improving and we might be coming into a cyclical, more beneficial era for the company. So it's relatively cheap to the long-term history. It looks like the collections process is improving, that sort of backdrop. The pricing of many of these debt ledgers has improved as well. So we're quietly comfortable building a position in Credit Corp.
I like that, a whole era of prosperity ahead of us. Okay, let's go to the top end of the market. Best result for the season.
Best result for the season from our standpoint was Pro Medicus. This is a business that trades on nosebleed multiples, so it needs to do very well to justify those prices, and it did so. Net profit came in better than expected, margins were better than expected, cost growth was constrained, and they've managed to broaden their outlook somewhat. They used to historically service mainly the university-aligned hospitals. They're now moving into the bigger end of town in the US, servicing, I think, 11 of the top 20 hospitals there. So contract values continue to expand. So that for us seems to be a business that continues to deliver despite the lofty valuation. As
we know, Pro Medicus got a great image in the market. David, you got something that can do even better?
At least match it, I think, because Pro Medicus is a wonderful company. But the company that we think did exceptionally was WiseTech. You had revenues exceed $1 billion. Their guidance is heading towards EBITDA of nearly $700 million. Importantly, they signed up Nippon Express, and so they've now got contractual relationships with 14 of the top 25 forwarders. Those guys literally are Microsoft for the global freight forwarding market.
Yep, okay. Let's go to the other end of the market. Let's get a bit grumpy. Worst result for the season that when you sat there and looked at the numbers and went, oh, great, there's going to be a bad day?
I'd have to say it would be Seek, even though the stock's actually done okay since. But you basically had 25% earnings downgrades following the result. It was disappointing across both Australia and Asia. And here's the sort of boring fact for the day, is that Seek's EPS is now below where it was 10 years ago. And in the same time, REA and car sales EPS are up 2 to 3 times.
Okay. Michael? Worst.
Ordinate.
Get ordinary.
Ordinate. So this is a business I've been harping on about on Livewire for a couple of years. So I've got to take my medicine. Came into the office and it didn't look good at all. Essentially, a growth business trading on very lofty multiples won't be growing in FY25. Essentially, there's been a lot of pulled forward demand after the COVID backlog. That backlog's now cleared. It's just not as bright a picture as it once was. It's a top 5 holding in our fund, but the outlook is improving from FY26. It just might take a little bit of time for the market to come back in favour.
Catch up with you. Well, we started with downgrades. It was all a bit varied, but we ended on a pretty high note for the profit reporting season.